Stocks just closed lower for their second week in a row, and after a 46% run in stocks over the last 18 months, investors are worried that a stock market crash is on the way. Hey Bowtie Nation, Joseph Hogue with your weekly market update, 9 a.m. Eastern every Monday morning, getting you ready for the stocks to watch and the news this week. And Nation, while I believe this bull market is alive and charging, we could be in for that normal 5% correction, possibly even worse over the next few months. So I wanted to show you the 5 unmistakable signs of a stock crash, so you can be ready when the time comes. Stick around after that and I'll show you the stocks I'm watching this week, including major news on Nvidia, ticker NVDA, SoFi Technologies, SOFI, and ChargePoint Holdings. Before that, if you want to see the 5 stocks I'm buying for the next 30 years, my forever stocks, look for the link I'll leave in the description below. It's a free report I put together with the Motley Fool, some of the biggest stocks in my portfolio. And these are the stocks I'm following in major multi-year themes, with one of the picks up 100% and the group up an average 94% last year alone. That report is totally free. You'll see the first stock immediately and they'll email you the full report with the other stocks. It's an easy way to support the Let's Talk Money community and see some of my favorite stocks to buy, so look for that link or scan the QR code here. But back to those signs of a stock market crash, and after a 23% run last year and nearly 9% already this year, investors are understandably worried that stocks are in a bubble ready to crash. Even barring a full-blown crash though, technically a drop of 20% or more from the peak, a correction of 10% or more is never easy, so I wanted to detail where we are and warning signs that precede a falling market. Then I'll help you outline some ideas on what you might do to avoid getting caught in a crash. First off, a stock market bubble has no formal definition. While there have been clear bubbles in the past, like Holland's tulips and the dot-com stocks of the late 90s, the media raises calls for a bubble nearly constantly. In fact, after more than 25 years investing, I think the reason for 90% of the calls that stocks are in a bubble come from those that have missed out on the stocks making those biggest returns, and they just need those cathartic excuses for why they're right and the market is wrong. It's like if you're not a Bitcoin investor and Bitcoin is booming, then it's a bubble. If you're not a tech investor and those AI stocks are minting millionaires, it's a bubble, and those millionaires are going to be sorry eventually. Of course, that's not to say that stocks are never in a bubble or that the market doesn't get overbought frequently. It also doesn't mean that you should ignore the bears completely and never protect yourself from that pullback. Now, I've been buying shares of SoFi Technologies, ticker SOFI, since May of 2022 and have cost basis of $5.62 on over 16,000 shares in my main account. It's a nice $22,000 profit even after the recent pullback, but I've managed to pocket an additional $54,800 by selling call options against the position when it reaches those overbought levels. So you see, a correction or even a crash in stocks doesn't have to mean you lose money, but you do need to know the warning signs and what to do ahead of time. One of the biggest warnings right now is that inflation is proving to be more resilient than expected. The rapid drop in the pace of inflation from 9% a year in June 2022 to 3% just 1 year after had the market thinking that price pressures were beaten. That helped stocks jump from their October 2022 low into this new bull market on expectations that the Fed would first stop raising rates and then quickly start cutting them. But after that initial victory, inflation has become much stickier and refuses to come down to the Fed's 2% target. Nearly a year from reaching that 3% level, we're still with the Consumer Price Index CPI at a 3.2% annual pace in February. And you can see what that's done to expectations for Fed rate cuts and for stocks. Where the market as recently as January was expecting that first rate cut to come in March, now the market is only placing 62% odds that the Fed will eventually cut rates by June and no chance of a March cut. If inflation reports like the PCE at the end of this month and one more month of the CPI showing price increases over 3%, it's going to be unlikely that the Fed will even cut in June, and stocks could react negatively to the idea that higher rates are here to stay. A much less technical signal is the overall bullishness of investors and what's been called the cover curse. Just last week, both Barron's and The Economist published covers trumpeting the new bull market, but not all are cheering. These displays of optimism from the media have more often than not been previewed to the change in the market, like when Time magazine covered the secrets of the new Silicon Valley and GetRich.com September 1999, just 4 months before the dot-com bubble peak. Or when Businessweek called for the death of equities in August 1979, just before the 80s boom that doubled stock prices. In fact, in a study of 50 magazine covers going back 25 years, researchers have found that this level of media optimism or negativity is a contrarian indicator with a 68% success rate. That means if you were to bet against the cover's thesis, You could have called a market change 7 out of 10 times. And it's not just the media that's overly bullish. The percentage of investors with a bullish viewpoint in the American Association of Individual Investors weekly survey jumped to 51.7% last week. It's only the 4th time it's peaked above 50% in the past 3 years. The market's relative strength indicator, the RSI, a technical signal that measures stock prices, is currently at 76, with 80 being that level for significantly overbought on a short-term basis. Now, the use of borrowed money or margin debt is another often used signal for that market ripe for a pullback. Market regulator FINRA reports the overall level of borrowed money as well as the investment account balances. I've analyzed the recent data, and while the total level of borrowed margin debt at $700 billion is down from the $900 billion peak we saw in 2021, it still shows investors dangerously overextended. Worse, though, is the ratio of borrowed money to account balances, so how much people have borrowed against what's in their account, is the highest it's been at over 4.5 times. Investors collectively have borrowed 4.5 times as much money as they have in their accounts. And it's that level of indebtedness that can easily turn a normal stock correction into a crash as margin calls force those investors to sell. Now, another stock signal, though, is weakness for the theme or the stocks that have been leading the bull market. The Magnificent Seven stocks of Apple, Tesla, Nvidia, Amazon, Alphabet, Meta, and Microsoft dragged the market kicking and screaming higher in 2023 for a 23% return. Were it not for those 7 stocks, though, the other 493 stocks in the S&P 500 index only rose 12% for the year. It's not bad, but wouldn't have caused that level of optimism that we're seeing today. That outperformance has taken those 7 biggest tech names to account for nearly 30% of the stock market index. That's by far the most weighting for the largest 7 companies, going back to at least 1980, and means where these 7 stocks go, so goes the market and investors' hopes. But that level of dependence might now turn against the market. The Magnificent 7 has turned into really the Magnificent 2, or maybe even the Mag 3, with Apple down 10% this year, Tesla plunging by 34%, and Alphabet's Google barely able to hold on to that 2% return. Were it not for Nvidia's 76% run and Meta's rising 40%, the market would look far less healthy, and with that weighting of these 7 stocks, the market index is going to struggle for as long as their weakness continues. The 4th market signal is really unrealistic expectations and valuations. Most talk of a bubble right now is in those individual stocks like ARM Holdings, trading for nearly 1,600 times its earnings, 46 times on a price-to-sales basis, or in themes like AI stocks, but the overall market is looking pretty richly priced as well. The forward PE ratio, that's the price of the S&P index divided by the earnings that analysts expect companies to report over the next year, is now at 20.7 times. That's 9% above the 5-year average and 16% premium to the 10-year average at 17.8 times expected earnings. True, it's not as high as the 23 times multiple we saw at the height of the pandemic prices, but it is expensive and may be more expensive than it seems. That's because right now, analysts expect companies in the S&P 500 to report $244 in earnings per share over this year. That's growth of 9.5% from last year, and a 13.3% growth to $276 per share in 2025. That would be very strong earnings growth, especially considering a slowing economy, still high interest rates, and the fact that earnings grew just 1.7% last year. If instead earnings grew just 6.5% to $237 per share, then the forward PE ratio for stocks would right now be 21.7 times. That's very close to the pandemic high. We know what happened to many stocks coming off those highs. One more signal here, and I'll outline some ideas on how to protect yourself and be ready in case we see a stock correction or even a crash. We're approaching a seasonally tough time for the market, that sell in May phenomenon. While it doesn't play out every year, there are intuitive reasons why stocks typically suffer through those summer months from May through October. The summer brings vacations and just better things to do than sitting in front of a screen of stocks. That means market liquidity usually falls and amplifies those moves to the downside. This could be especially true as retail investors become a larger part of the market and send those stocks booming higher or crashing lower after they've lost interest. But even with all 5 of these signals flashing yellow or red, it doesn't mean stocks will crash. Bear markets don't kill the bull just because stocks get expensive. That bear needs a catalyst, a reason to mull. A pushback on the Fed rate cut expectations and slightly lower earnings could drive a 5 or even a 10% correction in stocks, but a full-blown crash is less likely at this point. That leaves you with 3 tactical options for your portfolio. First is you can just do nothing, just invest as you normally do. The bull market is still strong, and even if stocks do fall 5 or 10% over the next few months, that likelihood that stocks will finish higher over the next couple of years is very strong. You could also look for stocks that haven't participated in the rally and that are attractive even if the overall market weakens. Stocks of real estate companies are up just 8% over the last year, and utilities are down 2% over the period. At a forward PE ratio of just 8 times, I think Alibaba, ticker BABA, is one of the best buys in the market and is the largest position in my portfolio. I also like ChargePoint Holdings, ticker CHPT, as a turnaround play, and even Apple and Tesla are looking attractive after their 2024 tumble. Already down and in value territory, these stocks are going to have less room to fall if the market plunges. You can also make sure your portfolio is invested in quality companies. These are stocks beating the rule of 40, where revenue growth plus profitability is 40 or higher, like we detailed in a video last week. This is the #1 measure I used during my time as a venture capital analyst to find quality companies that could create that lasting value. Of course, these aren't the only signals for a potential stock market crash, but they are the loudest right now, and they are all flashing warning for investors. The upside is that any dip into stocks should be a buying opportunity into the bull market, which should continue over the next few years. Turning it over to the stocks I'm watching this week, WW International, ticker WW, could have a very big day Tuesday after a 20% pop in the shares last Friday. Oprah Winfrey revealed to Jimmy Kimmel on his late show Thursday night that the reason she left the company's board of directors is that she didn't want it to appear a conflict of interest for her upcoming primetime special on weight loss, scheduled tonight on ABC. Shares of WW tanked 28% when it was announced she would leave the board of directors and donate her shares to charity after being one of the company's biggest investors for almost 9 years. The 8 p.m. Eastern special tonight, titled Shame, Blame, and the Weight Loss Revolution, will highlight Oprah's decades-long struggle with weight loss and recent use of those GLP-1 drugs. As an active member of WW International while she was in that weight loss transition, the special could amount to be kind of a commercial for the company's new weight management clinic that offers those GLP-1 drugs, and that's what drove the shares higher Friday. I continue to hold the stock and will buy more Monday today on this news. It's very high-risk, high-return potential stock, though, with the company's main weight loss program stalling out against those new weight loss drugs. The clinic portion is as yet a tiny part of revenues. It's going to need to grow quickly to prop up the rest of the company, but there is no debt due until 2028, which gives the company a considerable amount of time. SoFi Technologies, ticker SOFI, is now down 32% from that 10-plus share price it traded at in December and continues to be in that boom-bust trend that we've seen over the past 2 years. The price-to-book value is starting to look attractive again at 1.3 times versus a high of 2.0 times in the price-to-book last year, and even though it's still well above the 0.83 times valuation we saw at the low. SoFi continues to be one of my largest holdings in that strong growth in banking and none of the problems like commercial real estate or deposit loss like we've seen across the industry. Management expects to reach profitability this year and continue that 16% revenue growth. ChargePoint Holdings, ticker CHPT, plunged 16% last week and is close to its 52-week low as the market continues to sell anything EV related. I believe the market is pricing in a necessary capital raise, likely a convertible debt issue over the next couple of months. The company has plenty of cash on hand, but is also still cash flow negative. That said, this is still a leader in charging stations, a severe bottleneck in the industry with billions of dollars in federal incentives that should see increased announcements over the rest of the year. The company has no debt due until 2028 and expects to reach EBITDA profitability by the end of this year. Usage stats on stations across the U.S. are now to the point of profitability, and nearly half of the company's revenue is from recurring subscription services. This is important because the software subscriptions are extremely sticky, as it would require a change of hardware to switch providers. Subscription revenue grew 41% over the last year and is now 24% of total revenue. And we probably don't have any near-term catalysts here until May, but the stock could be a very good long-term return. Nvidia Corporation, ticker NVDA, starts its annual GTC conference this week, with the tech darling expected to roll out its successor chips to the Hopper graphics architecture and H100 processing unit, those go-to cards for AI models. The new architecture has been codenamed Blackwell and could be a leap in performance. The company is also expected to announce production of its H20 AI chip for the Chinese market as kind of that alternative to get around the US chip export restrictions. Shares are basically flat for the last month as investors wait for that next big driver, so this week's rollout and outlook are going to be key in seeing that. Showing you that big picture with the SectorSpider.com sector tracker here. Great free resource online. 4 of the 11 stock sectors did close higher last week, with energy out the clear standout on those higher oil prices. I would hesitate to add meaningfully to any oil stock positions at this point, though, as I think the price of oil is more likely to head lower, back into that $73 to $78 range than higher. Long-term investors, though, can hold on the idea that oil companies are strongly cash flow positive at this price of crude, where it is right now at $80, even $70 a barrel. Most of the oil companies have cost of production well under $40 or $50 per barrel. Now, interest rate sensitive stocks in the utilities and real estate did suffer as the rate of the 10-year Treasury jumped back towards its near-term high. It's right around 4.3% on higher inflation reports. We're going to have to wait to the end of the month and then the April 10th to see that next PCE and CPI inflation reports. And until then, these sectors are likely to remain under pressure. Looking at a longer-term trend here, even without the 34% drop in shares of Tesla, which account for 11% of the sector weighting, stocks in the consumer discretionary group have lagged this year with a 3.6%, that's ex-Tesla return, the third worst performing sector. Cruise line and internet travel booking stocks have also noticeably lagged, both coming off strong returns last year, while auto parts and hotel stocks have done really well. All three major indexes did close lower last week for the second week in a row, though not by enough to really get worried about. Overall market sentiment is still strong, and stocks are still up 8% for the year. In fact, on Friday's drop that pushed stocks into the red for the week, 1,554 stocks on the NYSE saw higher prices, while only 1,247 declined. The advanced decline ratio on the NASDAQ of 2248 up and 2032 down was only slightly less bullish, but both showed that upward market trend is still intact, with more stocks rising than falling. The reason the bull market looks so much weaker, though, is on the underperformance of those biggest stocks. I pointed out in the beginning of the year that it's going to be difficult for the S&P 500 index to rise this year if that Magnificent Seven lost their leadership. Heavyweights like Microsoft, Amazon, Meta, and Alphabet all lost more than 1% Friday, while only Tesla finished higher. Investor sentiment seems to have shifted from these seven behemoths, and that's going to continue to weigh on the overall market. Look for the link below and see the stocks I'm buying for the next 30 years, my forever stocks. Get your free report and help support the channel. Or click on the video to the right to see how to invest $1,000 for dividend income every week. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.